Thanks. Okay. Nice. Oh, I don't get to participate in the poll. There we go. Yes. Okay, well, why don't maybe we'll just get started. We'll have some people popping in here now and again. But let me just introduce, let me change. I don't know what you guys can see. And I think you can change your gallery view or how you're viewing your screen on your own. But up in the right-hand corner. So if you can't, then I'll just have Ethan change it over to maybe just the speaker during like Brandon's presentation. And then when we're having like maybe a group discussion or if we have questions, then we'll switch it back over to the gallery view. But right now I'll just put it over to here. And I don't know if that changes for you guys, but it is fine. So anyways, just we're happy to have Brandon here. He is down in St. George. He was with a group and I should have asked you for a bio and I didn't. And I'm so sorry. So I'll let him fill in all the gaps. But I was introduced to him last year. He came up and did a presentation for realtors in our area at Karen Nielsen's office here in Logan at Guild Mortgage. And it was awesome. I remember coming in thinking, I'm going to hate this. I don't even like these kinds of mortgages and these kinds of loans. I think they're terrible. And I left thinking, when can I be old enough to do something like this? So we thought it would be amazing to share this with our people. And so we've asked him to participate tonight in this webinar. And so without any more from me, I'll let Brandon maybe give an introduction on how he came to be in this field and why he does what he does.
Well, super. Just make sure everybody can hear me. Can everybody hear me okay? It's all good. All right. I'm with a company called Cherry Creek Mortgage Bank, but Karen's Guild Group purchased us about a year and a half ago. So we're a division of Guild, which just means we're all Guild. So I represent the reverse division. And HUD's recoined that and renamed that. So it had such an old, bad, negative connotation that they call it the Senior Flex Loan. So it's an FHA Senior Flex Loan. So all of the HUD promotional materials and stuff is now referred to as a Senior Flex Loan. And we'll talk about that. But I've been lucky enough to fund more of these than anybody in the country. We've funded about 3,000 of these. We're based out of St. George, Utah. Here in Southern Utah, literally about half our clients use that loan versus a 30-year fixed or paying cash. So it's extremely popular. I think if people could understand how it works and how to use it when they're buying a house and or when they're paying off a loan or mortgage, literally, if everybody could wrap their arms around it, I still think half of our clients over 65 would be in that loan. So Karen's on the call with us tonight. Also, if you're a real estate agent or Shannon, if you're moving this and somebody gets through it, they do get a CE hour, whether we spend half hour, 45 minutes or whatever the time they can. I just need to get those contacts, emails, phone numbers back so I can register the CE hour with the state. So yeah, let's talk about that. We're going to start with kind of how we use it down here the most, and that's really with buying a home. People don't realize that they can use a reverse loan or a senior flex when they buy a house, and that's really what I use the most. So it used to be, guys, that you could buy a house for half price and then not have any payments for life. So all these 55 plus communities down here, Southern Nevada, Utah, they'll advertise, buy this house for half price and have no mortgage payments, right? So you're buying a $500,000 house and you're putting $250,000 down. You're borrowing $250,000 in a mortgage that if you want to make payments, you can. And if you don't want to, you don't have to. But that's really all it is. So it's the same as a regular 30-year fixed, but you're putting so much down that if you want to make payments, you can, and if not, you don't have to. And if you don't, then that loan is growing every year. So I'm going to go to a screen here in a second and describe that. But what's happened over the last couple of years is interest rates have gone from 3% to 6% plus. So what that does on the senior flex loan is that means you have to put more down to buy that house. So today it's about 60%, depending on your age. So if you buy a house for $500,000, you're going to need $300,000 to buy it. So the first thing that people do is they come to agents and they'll say, hey, I'm looking for a house at $350,000. And they're older, they're at 62 plus. But quite frankly, Shannon's not going to have a house that they're going to be tickled with for $300,000. But they could go buy a house for $500,000 and put their $300,000 down and never have a payment the rest of their life. Right? It's the coolest thing. People will come in the office and they say, well, I don't want to do a reverse loan. They've got such a bad name to them. And after they understand how they work, they end up buying a $450,000 house and having no payments and still having money left over. So, so when we get done, I'm going to send you 2 or 3 brochures that we use and also a short 2 or 3 minute video. So that's just kind of how you're buying a house. I've also got one, how to pay off a house. So there's just 3 2-minute videos, real simple. If kids want to watch them, if you want to send them to realtors or your agents or your lenders, it's really the simplest piece. So when we get done, I'll just make sure everybody has the short videos and we go from there. So I'm going to try to share this screen and try to go to a drawing pad if everybody can hang in with me real quick. Let me see real fast.
Why don't I do a poll while you're getting that up? Will it let me do both?
That I don't know. So let's see real quick. Your polls, let's see.
Ah, here we go. You're ready.
Are you seeing a blank screen or my scribbles or not?
Yeah, looks good.
Just scribbling. Is that what you're seeing?
Mm-hmm.
Okay. All right. So let's back up real quick. So we're going to buy this house and slow it down a little bit. So let's say I go buy a house for 600 or 500,000. Let's see. I can't write on the screen very well, but geez. So I pay 500,000 for this house. Let me just back up. It's the first one we tried on Zoom, so let's try it. Okay, can you see that? Just cross T-bar. Okay. All right, so if I want to buy this house, I'm over 65. I've got to put down literally about 60%. So I'm going to put down 300,000. So that's my equity, if I can spell it. And then this is my loan. My loan's going to be 200,000. Right now, that's growing about 6.5%. So we try to keep it about the same as a 30-year fixed. The Fed moved rates down about 3 weeks ago, and every day it's just shot up. So we got into the high 5s, and now all of a sudden we're back closer to 6.5. So at some point, I promise you, they'll come back down for Karen and I. But right this second, we try to track a 30-year fixed. So you're going to put down 300,000. You're going to buy this house for 500. You're going to borrow 200, and that interest is about 6.5%. If you want to make payments, you can. If you don't, that's just growing. So if you don't make any payments, 10 years from now, you're going to owe 350,000, right? So if you passed 10 years from now, the kids will get this house that's probably going to be worth 600,000 or 700,000, and they're going to owe back what's owed, and the rest is their equity. So it's a flex loan. They call it a flex loan because if you want to make payments, you can make payments. If not, you don't. But if not, that interest is just growing over time. So people always ask, Brandon, so my kids will benefit so much better if I make payments. Well, it's the same because they're putting their cash into the house and they're bringing the loan down. But if they don't put their cash in the house, the kids are going to get the same. They're going to get savings plus the house. So if the interest rate's the same, then the kids are going to end up with the same amount at the end of the day. Unless the parents go spend the money, and I hope they do, right? But quite frankly, if they buy this house for 500,000, there's no term. If clients come in and they don't have any kids, or they have as many as I do, we have 7, then it's a no-brainer. Like, you would buy that house, you would never pay cash when you could buy it for 300 grand and be out. If I want to pay it off, I can at any point. So that's why it's called the Senior Flex Loan. It's got the same interest carry basically, and it's up to you whether you not make payments. Now, here's the coolest thing about this though. If I buy this house for 500,000 and I put my 300 down and I owe 200, if I want to make extra money or payments into the house, let's say I had an extra 100,000 bucks. For some reason, it's not writing. And I'm going to put it into my house. So I'm going to actually put 100,000 and lower my loan amount to 100,000. So now I only owe Karen 100,000 at 6.5%. But the extra money that I put in there goes into a side account, and it's a savings line of credit. So they have to pay me the same rate of interest that they're charging on the loan. So when you buy a house with a flex loan, you buy a much nicer home than you probably would have because you don't have a house payment. But it provides a savings account that's tax-free, federally insured, and I can take it out anytime I want for the rest of my life. So none of my clients have CDs or money market accounts because they're using their house as their savings account. Every month you get a statement from Karen. It's going to show what's on your loan and how much you have in your savings, and there's a blank check. So if you want to pull money out of it, you write the check, you can send it in. It takes us 5 days to move it from this account into your normal bank or checking account. And that's it, guys. You just go back and forth between that account the rest of your life. So think through this real quickly. Let's say, what happens if I buy this house for 500,000 and I put 300 down and I owe Karen 200, and the next day I bring in a check and I pay this house off? The 200 goes into the savings, earning 6.5%. You own a home free and clear, but in 10 years, that's growing, and now it's got 400,000 in it. It's the coolest thing on the planet because you've got this home that you owe nothing on. And if I died, my wife's got a house free and clear, and she's just added 400,000 to her retirement if she needs it. And I promise you, so many clients are in that boat. They probably bought this house 20 years ago. They've paid it off, and they've got this house free and clear, but all their cash is tied. It's not all their cash. A chunk of cash is tied up into that house. So I think it's the coolest option on the planet to buy a house, because I'll have clients come in and they'll say, Brandon, I'm looking for, or Shannon, I'm looking for a house at 450. But let's say they have 450,000, and Shannon shows them a house they're tickled with for 600. So they're going to put their 360 down and owe 240, and they still have 90,000 left over from their savings. So they would put it into their house and drop their loan down to 150, but that 90,000 extra goes into that savings, earning 6.5%. So instead of buying a house for 450, they bought a nicer house for 600, and they have an extra 90,000 in the savings, earning 6.5%, that they can take out anytime they want. It's federally insured, just like any savings CD, but it's not locked in there for any time. I could bring a check into Karen for 90,000 and tomorrow come back and say, geez, almighty, my car blew up. I need 30,000 for a new car, and take it right back out. I'm telling you, if clients knew how that worked, every client would buy a house if they're old enough and they have that big a down payment with a senior flex loan. So this morning, we've got a radio show that we do on, it's a financial show down here in Southern Utah, and we're running into a lot of people that have paid off the house, and they have this house that might be worth 700,000 today. And they're worried about elections, and they're worried about, the world going to heck in a handbasket. So if they don't owe anything, Karen would drop a line of credit or a savings line directly into that account for about 300,000. You have a home free and clear. You've got 300,000 to work with, and that's growing at 6.5%. In 10 years, that's going to be 500,000, right? Or you could take the interest off of that each month. The interest alone is about $1,600 a month, and never dip into your 300,000. If you're short on cash flow and income, if I lost a spouse and I lost a Social Security, Karen could set up that account, generate $1,600 a month without ever tipping into that safety cushion of the 300,000. So that is your insurance fund. That's your safety. That's your long-term health care plan. That's your medical emergency. That's anything. And probably over your lifetime, you'll use 150,000 because you might need it. You probably will use it. But the kids will still get this house that's worth probably 850 or 900,000 in the future, and they might owe 150. The point is, I promise you, the kids will get plenty of equity. It's just a cool way of freeing up some equity with no payments. So Karen's options are, I can give you a 30-year fixed and you can make a payment to us. I could give you a HELOC, but HELOCs are based on prime rates, so they're like 8.5%. And if I take money out, I got to make payments on that. This is the only HELOC that does two things. If I take money out, I don't have to make payments, and it's got a lower rate based on a 30-year fixed. And while it's sitting there, it's accruing and growing interest. So it doesn't matter if this house goes down in value, I always have that account. So if I'm buying a house, or if I've got a home that I've been in and I don't want to move, I can open that line of credit, and it's my safety or emergency fund for the rest of my life. The last thing is, I'll show you one before we open some questions up, is so Dave Ramsey, I was on his show a few years ago, and Dave Ramsey's a huge fan of don't retire until your house is paid off. Don't retire until your house is paid off. So I'm 72, I'm still working, running auto parts or whatever I'm doing. But for sure, I'm going to make sure I work until that house is paid off. right? I got a $700,000 house and I owe 150, and I'm still making $1,000 payment. At 72, 73. Guys, that's absolutely silly. You've got so much equity in this house that you build up. Karen would drop an account for 300,000. We pay off the house with half of that. So now you have 150,000 left over and you have no payments. You can either work until you finish paying off the house like Dave thinks, or we can use that line and we can pay off the house. You still have 150,000. And by the way, if you still want to work and make payments, do. But every payment now is adding to your line of credit or your savings while it's paying that down instead of just locked up in the house. So everybody has a bad connotation because I promise you, nobody knows how that works. You can buy a house. If you have it own free and clear, you can just open a line and let it go. Or if you have a small mortgage on it, then you can pay it off and you can still make payments if you want to, because there's no downside. It's going to go against the loan and go into that savings, and I can still write a check and pull it out anytime I want. So that's why they've got away from the old negative reverse. This is just a senior flex loan. It's a line of credit. Same interest as a 30-year fix, basically, and it just gives you the flexibility to make payments. And guys, that's it. So
Isn't that amazing?
question, Shannon, if you've got some or if clients have got some, and let's kind of, I know that was probably fast and everybody's like, oh, okay, I got maybe some of that, but tell me
And
what.
we may want to slow back down with like a specific scenario if someone wants
Okay.
to present one. And I do have a question, like I think it's amazing. And I did connect you after we had our first meeting with you. I did connect you actually with Ethan's parents, and his mom has since passed, but it wasn't a good option for them. When wouldn't it be a good option?
If you have a high mortgage on it, let's say you have a house that you owe 300,000 and Karen's got you into an interest rate of 3%. And you make plenty of income, plenty of money. So you're not worried about the payment. If I take the flex loan and pay it off, I'm moving you from the 3% to today's rate at 6.5%. And so, yeah, there's no payment on it. Yeah, you can make payments and pull it out, but I'm still increasing that old interest from 3 to 6. And if you have zero issues making that payment, it's the same thing as Karen has when she's trying to refinance. Geez, do I really want to refinance and go from 3 to 6? So that's probably the scenario. They probably had a heavy loan. They had a good interest rate. And right this minute, their income was fine where they were just going to make it. So I would say just keep pummeling money at the 3%. And if you decide to retire or stop working, then maybe we look at the flex loan, because now we don't want to keep making those payments or can't. So then we could flip it over at that point in the future. So sometimes we'll run into that.
Okay. So I think ultimately you're looking at people who are retiring, who want to improve their lifestyle and maybe want a little bit more monthly to utilize from the equity that they have and not add another payment so that they can go on a trip or whatever. It's just using equity that they already have in their home. And quite honestly, I know you keep saying, don't worry about your kids. Really, don't worry about your kids. It's your money. I tell my parents that all the time. I'm like, we don't, I mean, it'd be nice, but we don't need your money. You spend your own money. We want you to live a happy, fulfilled life. Like you work so hard your whole life. Why not enjoy it when you can? So.
And that's a good point. And here's the thing, if you bought this house, let's say you bought it 10 years ago for 300,000 and now it's worth 600,000. Quite frankly, your kids are going to get all that benefit. I promise you, if you needed to use 200,000 of that, the kids are still going to get 400,000, probably more than what you paid for it. So with my dad, he bought a home many years ago. He was in his 12 years and we lost him a couple of years ago, but it's the same thing. He was looking for a house around 350. And like, we can't find a house that you're going to be tickled with for 350, Dad, but you could buy a $500,000 house for 250 and you'd still have 100,000 left over. So that's what he did. Then a couple of years ago, we lost him and we sold his house, and we had more equity when we sold it than when he bought it in the first place, even though he hadn't made any payments because the house just outpaced the loan. So he bought a nicer home. He lived in it for the last 12 years of his life in a better home. And we as kids ended up with more money than he started in the first place, even though he didn't have any payments for the rest of his life. A typical example of clients are this is they're doing just fine, but if we lose a spouse, we lose a Social Security or part of a pension. And so at that point, if we're trying to make a mortgage payment, or cash flow might get fairly tight. So in the flex loan, we come in and we pay the loan off. While there's still two incomes, there's two socials, we still keep piling extra money in the house. And then if I lose a spouse, she can stop making any payments, and now she has that extra cushion that she can draw from at the same time. And I'm telling you, if it was my wife, over and over again, it's like, okay, honey, if something happens to me, you've got a house paid for. You're free and clear no matter what. And the extra money in that account is tax-free. You can pull it out as you need it. You've got your Social Security plus this little bit of IRA. You're going to be fine. And when you put up those poll numbers, the number one concern in the world, if you're over 62, is just running out of money. We're more afraid of running out of money than we are of dying. And it scares the daylights out of people. And so I think that if you just, I had to be, and I'll tell you one quick story. I had to go to Nashville for a Guild event, because that's what Guild does, is have these meetings, right, Karen, that we constantly. So interest rates have gone up, right? Interest rates gone up through the roof. I come back, I had to cancel a bunch of refis because rates went through the roof. I'm in the office on a Saturday, I go get the mail, and there's a card that I keep in my wallet from last week. And it says, it was a client that from 2 years ago. And it reads, Mr. Hanson, I just wanted to drop you a note and let you know that I lost Gerald last month on the 18th. His colon cancer was a rough go this year, and he left this earth for a better one. As I'm sitting here writing you a note, I just wanted to tell you, thank you for being there for us. He was on hospice, as you know, for the last month. And as I sat with him the night before his passing, and the last night I had with him on this earth, we were talking about you. He said, if I feel that I have to leave you on this earth, please remember what Brandon said and call him anytime. Honey, you have no house payment, and you have additional funds with my pension, and you'll never run out of money. So live life, honey, and take care of our family. And she said, that was one of the final thoughts he had shared with me. You left me peace in my heart, but maybe more importantly, peace in his, knowing that he could leave this earth, knowing that I'd be okay. And that's the purpose of this loan. It's more than just a 30-year fix that I can try to drop the rate. It changes your life, right? It changes what you buy. It changes whether you take a trip once a year. It changes whether or not you feel like you're going to go to dinner when you want to. It's the only loan on the planet that I know that does that. And the more you have the loan, the longer you have it, the cooler it is. because you get your statements. It's like an investment account. You know what's in there and what's growing. And so that's a good example. Any other examples? I can keep throwing lots of examples, but you tell me if there's any specific ones or want a situation, a hypothetical, you tell me.
Yeah, and anybody's here, please feel free to unmute and ask any questions that you have, or put them in the chat. I know some of you, your computers aren't letting you speak, so you can put it in the chat. You can text me on the site and I can ask for you. But I remember an example, and something that you've kind of touched on was maybe quality of living, where someone maybe feels like they can only afford the 350, but this kind of a loan allows them to live in something much nicer, much more comfortable. I think I love that idea, but there's really nothing around living in something nicer because you're not making a payment. Do I understand that correctly?
That's exactly right. So we're probably not talking about instead of buying a $300,000 house, buying a $600,000 house. But there's a difference between a $400,000 house and a 550. So if you're showing clients, I promise you they'll be tickled with what you're showing them at 550 versus a 400. And the thought is, are my kids going to lose out because this equity is going to get eaten up? The math shows that if I buy a $550,000 house and I put 400 down, I only owe 150. That home is going to outpace the loan, and my kids will get more equity out of a more quality or expensive home than they will if I pay cash for a older home at 375,000. And I'm going to argue that the kids benefit, my clients benefit the most. But if you're buying a new construction, usually you end up buying something that you're tickled with and you put more upgrades in it because you have money for the blinds and you have money for floors. And instead of this cabinet, you could go to the next cabinet. So it's just like buying a little bit nicer home that you're not going to be settling for. And this is probably going to be your last house. So if Shannon sends a client to Karen or I, we go through a 30-year fix versus this loan. And I just feel like if we did a good job of teaching and showing how that loan works, they'll buy a little nicer home. Not that we care. It's just we care that they're going to be a little happier than they would if they settled for this house in this neighborhood with, this situation. So,
And quite possibly they can live closer to their kids, or it just may change the dynamics of what they can look for, even if it's a 55 and older. I think down in St. George, you're probably dealing with a lot of communities that it would maybe play out more in the upgrades that they can add to the new construction home in that community. Here, probably the same, but not so much. But I think here it would maybe dictate more location, maybe the newness of the home, maybe the amenities around it, stuff like that instead of more so upgrades. But yeah.
The other thing is we've got another one that's trying to move into Salt Lake from Idaho. But her price in Idaho is like 250,000. Her kids live in Salt Lake and it's a fortune in Salt Lake. So she's like, there's no way, Brandon, I can get closer to my kids, but I need help. Like at my age, I can't, I'm by myself up here. And I'm like, you can. You can sell that house for 250, move to Salt Lake, buy a townhome for 400, 425, 450, and have no payments. You can afford to do that by yourself and you move closer to your kids. And I promise you, your kids are going to be happier. And so it solves for some of those issues where some communities are just so expensive that that's the only way you can get into that house is with that loan. What happens if you buy the house and you don't like it? Are you stuck there? Guys, it's just a loan. Sell it. Pay off what's owed and you can use it again and again and again. So what happens if my house goes up next year or interest rates go down? So if the house goes up and interest rates go down, you can do a streamline and we can just throw more money into that savings line, drop the rate, just like any other loan, and they don't charge you the fees to do that. It's a government loan, so they don't hit you with the upfront fees that it costs to go into the loan in the first place. So,
In your T graph, where you were showing the interest rate on the loan part, but then when you were dumping money in where they were gaining interest on the other side, are those equal to each other, or is that just like what drives the interest rate on your money that you put in?
so the interest rate is 2% above a 1-year treasury bill, which is basically follows a 30-year fixed rate. So a 30-year fixed is usually 2% above a 10-year treasury and or 1 year, and this is what that rate is. It's basically 2% above a treasury. But that's exactly right. The HUD rule is those rates always have to be the same. So if rates drop, your loan percentage drops, but the interest you're earning on the savings line of credit is also dropping. If it goes up, those two have to always mirror each other one way or the other. So if it's paying 2% above a treasury or CD, that just means that you're always going to make 2% higher than any savings account or CD, your treasury bill, and it's still tax-free and federally insured. So all of my extra money for clients still pummel into that house. And I'm one of the few guys that keep teaching that. Everybody says, well, yeah, you can buy a house with Shannon for $300,000 and you can buy a $500,000 house and have no payments. And that is cool. That's where everybody stops. But they miss the whole aspect of using the house as your savings account, because there's nothing on the planet that pays that kind of interest tax-free, and that you can just pull it out anytime you want. It's not an investment account. It doesn't have capital gains or taxes to it. So, and it doesn't benefit Karen or I if the money's in there. So we don't care what you do. We want you to go use it as much as you want to, right? So that's the point. And I had a client this morning. Let me go through one other scenario. They have an expensive home up on the Four Master Ridge, and it's $1 million home. And he's got Parkinson's, and they have 2 Social Securities, and the house is just too much. They're like, geez, Brandon, we love our house, but we need to downsize because his Parkinson's can't keep up, and at some point I'm going to lose him. And so they were going to have to move after 20 years and go into something else. And I said, okay, you've got a couple of options. Number one, you can take your $1 million home and we'll put 400,000 in that account that's earning 6.5%, and you'll never run out of money. If you want to stay in the house, stay in the house. That 400,000 is generating more than his Social Security. You could strip the interest off. You'll never run out of money. If you want to sell it and downsize, then that's okay too. So we would do this. We would sell it. You sell it for $1 million. Let's see if I can write that. And let's say we buy something for 700,000. Using the flex loan, we've got to put down 400. So this is your down again, and this is your loan, and you borrow 300. So you sell this for $1 million. You take 400,000 and buy that house for 700, and you close. Then the next day, you're going to come in and pay it off. You're going to owe us 0, and you're going to move 300,000 in your savings, earning 6.5%. And you still have 300,000 in your bank account. So you've downsized from $1 million home to a nice home. You have 300,000 in this savings account earning 6.5. You've got an extra 300,000 in your own bank, and you have no house payment. You still own it free and clear, right? So the point is you can do whatever you want to do. We need to be careful with our advice. Wherever you want to stay, you stay. If we want to buy something, but if our real estate community knew how the loan worked, and I had an older client, because nobody wants a mortgage payment, but I promise you, you probably aren't going to be tickled with something I show you for 400,000. And that's the whole point today is you could find a house for 600,000 and you'll be tickled to death. You won't settle. You'll still have some money left over. You have a savings account, and I promise you the kids will still have plenty of money down the road. Does that help?
Yeah, it's so good. And Ethan has his hand raised, so he can ask us a question in a second, but I think the key is you still need a chunk of money. Like you need
Yeah.
and I think that's the only catch. And so hopefully at this point in your life, you've lived somewhere long enough that you have some kind of equity in your home or some of your investments that you have that you can create something like this. And I think one thing I just want to share is, and I alluded to it earlier, Brandon's not going to like put you into something that's not beneficial. And that was evidenced when I referred Ethan's parents to him because I knew that they felt financially strapped, but he helped them walk through their scenario and it wasn't beneficial to them. I feel like she would have done it in a heartbeat if it put an extra $1,000 a month in her pocket, but it wasn't beneficial for whatever reason. And he told them that. So it's not like he's going just to convince you that it's something great when it's not. And so I thought that was really helpful to know. So thank you.
Well, thanks. I do have to comment on that is there's only 7 servicers for HUD. So we service these loans for the rest of your life. We don't sell them. And we're the only servicer that's a forward and a reverse servicer. And I think that makes all the difference in the world. If somebody comes into the Logan office and is trying to buy a house, and Karen can go through a 30-year fix versus the flex loan, anybody else, our competitors with Mutual of Omaha or AAG or all of those are reversed, and they're going to slam you in a reverse loan, which now is called a flex loan. And they may or may not understand it, but just like Shannon said, it may not be the best fit right now. It might be a great fit 2 years from now or 3 years from now, but maybe right this second, just keep doing what you're doing. And I think that's what separates our team is we don't really care if we can help with a 30-year or 15 or a conventional or a HELOC. Sometimes it fits a little bit better. And especially if you think you're only going to have the loan for a year or two. The government charges you, when you take this loan out, they charge you a 2% fee, a 2%, it's like a VA funding fee or an FHA funding fee. So if I sold that house next year, I'd lose that fee that I just sunk in. So you go in with the mindset that you think you're going to have this house for 3 to 5 years. And then I think it's a no-brainer. If you're going to sell it in the first couple of years, it's probably not the best fit. And keep in mind, it can't be a rental property. It's got to be a home that you're going to be in 6 months out of the year. You can rent a room or anything like that. You can have a duplex and rent the other side. You can do all cool things, but you can't buy a rental and use that loan and live in California. That's one thing.
But it sounds like it could be a second home.
It
If
could
it's
be
six
when you're
and six.
retired, like
Okay.
you could, if you're retired, if you're clocking in and clocking out, then you really have to have a job. Then you basically can't say, okay, I'm going to live in St. George 6 months out of the year, because you've got to have a reason to be here 6 months out of the year. So if you have a home in Logan, I just have a client that has a home up on, what's the town just north of you? Starts with an H.
Hyde Park. Hyde
Hyde
Park.
Park. So they got a home up in Hyde Park and they bought a home down here. They they're going to sell that home in Hyde Park at some point, but they used a reverse to buy this house. They're going back and forth. I don't know if they're down here 6 months out of the year or up there 6 months, but it really doesn't matter. You can't rent this house. And at some point, I've got to know that you're going to be down here more than you're going to be up there. But we don't need to change driver's licenses or stuff like that. It's if you're retired, then it's basically just good faith saying that you're going to be down here most of the time.
Thank you. Ethan, what was your question?
So Brandon, I was just thinking, you know, as we show our clients homes, you know, if we have a client that wants to downsize to a historic home in downtown Logan, how are these loans underwritten? I mean, FHA, VA, conventional, if the house has peeling paint on it, you know, those kind of things that, you know, we have to look at as real estate professionals is how are these things underwritten? And are there any hurdles or anything that we need to worry about when, you know, somebody's looking to buy a home?
So good question. There's two things that come to my mind. First of all, they're FHA loans. So it's the same as a forward FHA loan. You're right. Peeling paint will be an issue. Railing on the stairs or porch will be an issue. Just typical stuff that you'll run into from an FHA standpoint. You can do it on manufactured homes or modular homes. The only downside is the condos that aren't FHA approved. But I think one of you had a townhome that we were going to do one on, and she ended up falling or breaking her hip. Is that one of your clients that you were referring to, Shannon, or not? No. But so it could be any home, single family, townhome, manufactured home, mobile home. It has to meet FHA guidelines. The tough thing that I see in our real estate side is if I had a client and Shannon showing the home and she said, hey, have you looked at the senior reverse loans? It has a negative connotation and it's like, no, I don't, that's going to come back on you. Like, what are you trying to sell me? Are you trying to sell me some loan that I'm going to lose my house? So there's two things about that. That's why HUD's changed and coined it different to the senior flex loan. They want to make sure that, and the other side of that is I think it's easier for Karen or I to bring up that discussion rather than you. Just say, hey, I work with some mortgage lenders that deal with seniors. There's some really cool flexible options out there. Just kind of brainstorm with them and then leave it at that. And then you're not pitching anything, selling anything. But if they spend a few minutes with Karen or I, they'll come back looking for a $500,000 house instead of maybe 400 and probably lean that way. But just be careful because they still have those old connotations. By the way, in the old days, before the government took them over, the old reverse loans, when I died, my kids owned the home. And when they sold it, they had to split the equity with the bank. They had to split the equity and there was equity shares. The interest rates were privatized, so they were high. So there was a lot of stuff that they deserve a bad name. So back in 2010, 2011, the government came in, kicked every private bank out. Now there's just only one loan. It's an FHA loan. And over the last 3 to 4 years, they've really kind of morphed that into a simple conventional loan and almost mirror a conventional loan. And then with the flex line and the loan, that's been available for the last 3 or 4 years. So those two features change the whole dynamics of that loan.
So I've got to ask. So you mentioned being on the radio with Dave Ramsey. I just became Ramsey Trusted, so I'm a Ramsey agent. I'm interested. I know you shared at our previous meeting kind of what he said to you because he is so hardcore in his beliefs and structure of 15-year mortgage, pay it off, you don't want a loan. I remember you having a really good conversation with him. So if you don't mind sharing that, that would be really helpful.
So yeah, and if you ever talk to him, you can bring it up. But so the two things that I have a difference with is, number one, a 15-year loan, like short-term rates are as high as long-term. So you don't get a break on rates anymore with a 15-year term or an ARM. So for the most part, everything's a 30-year fixed. And if you want to make a extra payments, make it and pay it off. So for the most part, I'm not a fan of any 15-year term, especially when rates are the same on both loans. So I was on his show, it was back in like 2014. And I had this client, first of all, so he invited us in. We flew to Denver, Colorado, and his producer said, hey, you just got to know that Dave's going to be down your throat about the reverse loan. So the first thing he did is I jumped on and he's like, okay, Brandon, so I got my home free and clear. You're going to give me $200,000. You're going to charge me 7%. I'm going to go put that in the bank earning 1%. How in the heck is that a good deal? You're going to give me $200,000 for free and I have no payments, but behind the scenes, you're going to charge me 7 and I'm making 1 in the bank. And so I let him talk, but I said, Dave, that's not how it works. If you open an account for $200,000, you're not moving it in your bank. It's already in a federal insured bank account, earning better interest than you can get anywhere out on the street. And it's not charging you anything until you use it. So it's the best safety cushion. I said, Dave, help me with this then. I got a client that has a house that's worth $200,000. Back then they were worth $200,000. And he owes $100,000 on it. He has a payment of $900 a month, and he just lost his wife. So he lost her social of the $1,000. That's what he was using. He's got $1,500 in his social. But now he's got $1,500 coming in. If I can write it. This scribble pad isn't working very well, but anyway, he's got $1,500 in his social. He lost his wife, and now he's got to make this payment out of that money. And so I said, Dave, what would you do? And he slowed it down and he said, listeners, this is black and white. I want everybody to take a note. That's exactly what he said. If you're in that situation at your age, you're going to take your house and sell it, pay off the loan, and go buy something for cash. Whatever that is, you're paying cash. And I said, okay, Dave, so my client's going to take his house, pay off the mortgage. After commissions, he might have 85 grand. So he's going to go move from his house that he's been in for a few years and move into a nice mobile home. Maybe not in St. George, but maybe somewhere outside of the area where he can buy something for $85,000. Or Dave, I could take my reverse. They were giving 50% of the time. I can come in and pay that house off. He keeps his $1,500 and his life doesn't change. His choice are, you're asking him to move into a mobile home or stay put and his life doesn't change. And he said, no, Brandon, you're exaggerating. Go find something that you can pay for $85,000. I'm like, Dave, I promise you, what are you going to find even 7-8 years ago for $85,000? Today, you can't find a good mobile home, let alone whatever that is. So absolutely, that's the most ridiculous argument in the world. I'm never going to tell my dad to sell his house and go buy a mobile home, for God's sake. You're going to stay put. You're going to be fine, Dad. Your life's not going to change. You got $1,500. You have no bills. We just got to make it on $1,500. But you've been doing that because Mom's social was paying that house payment. And that's when we use the loan. So I promise you, he would lose an argument with me on that loan. He doesn't know how that works. If you don't know how it works, then don't teach everybody that what's the good and the bad and the ugly about it. I do agree there's a lot of abuse. A lot of lenders are saying, here's $300,000, go do whatever you want to do, go travel the world and blow it. and they could go use the 300,000 and then they still are in the house for life. But if you're just educating the client, they're not going to go blow the 300,000. They're going to take a trip when they want to. In their 80s, we just don't spend as much. We don't feel like we want to travel as much. So I always tell my clients, in your 60s and 70s, please do everything you want to do, because you probably don't feel like traveling to back east to New York, let alone out of the country when at a certain point. So we just don't spend very much money when we get into our 80s. I wish you would, but that's the story. That's the Dave Ramsey story.
I love it. Thank you so much. This has all been helpful. If you can unmute, if you have a couple questions, if you want to, I will send out all of his contact information. And you can have like a one-on-one with him to maybe talk about your current situation. I know Ethan and I are not quite, what is the age group? We have like, what is the age? We didn't talk about that, I don't think, where you
You
can.
have to be 62. One spouse has to be 62.
Okay.
And there's other programs like private programs, you stay away from them, period. You only go with a government loan. You have to, one of you have to be 62, or I promise you that just, they're not good loans.
Okay. Any questions? I'll give it just a minute.
Well, somebody's raising again. As soon as I'll follow up, Shannon, I'll send you the videos with the brochures. Get
Okay.
those out to whoever you want. Keep those with the recordation of this and use it however you want to. Okay.
Great. I'll share it on our website and in the emails when I send this video to the people who were wanting a copy. So this will be great. Thank you so much. It doesn't appear that we have any questions. So for those that were here, thank you so much. Brandon, thank you so much for your time.
Okay. Appreciate everybody. My wife's up there. We got a daughter that's a cheerleader for the Aggies. So heaven forbid we need a win on Saturday. And so.
Yeah, I hope so. And I hope it just gets warm for her sake.
Yeah, true. Right? I hope it will.
Yeah, that's great. Thanks
All
so
right.
much. We'll
Take
see you
care.
soon. Thanks, everyone.
All right,
Bye-bye.
bye.